So you bought your property, maybe you got a tenant, you started building the portfolio and you're thinking, should I think about exiting? Should I think about selling the property? And in this video, I'm going to be breaking down exactly when you should do it. My name's Jamie York and we're talking property investment. So if you've seen some of my previous videos, you would have heard me saying something like, my exit is death, my retirement is death. And I do mean that because actually I have no intention of exiting my portfolio unless there's a fairly extreme reason to do it. But that's what I want to break down here, because should it be you always hold forever? Well, no, because actually there are going to be situations where it's a smart move to exit that. So the first thing is, what's your goal? What are you actually looking for right now? Because if you're looking to buy and live in the property, well, then actually it's going to be very different to if it's a buy to let or a flip. Now, what I really want to focus on is the buy to let in this. But before I deep dive in that, let's just cover living in it and using it as a flip. Well, flip. Pretty obvious, okay? If you are buying a property to flip, i.e. buying, refurbishing and selling, or maybe you're doing a trade where you buy it and then just sell it straight away, you just got it at a great discount, then obviously it's all about two things. Velocity of money, which means how quickly you get it turned around, back on the market and sold. And remember, the turnaround of money is often more important than how much money you're making in each deal. And the second thing is remembering that you make your money when you purchase the property, not when you sell the property. If the market happens to have gone up in that time, great, but actually you make your money from day one. What about if you're living in your property? Well, I'm not going to spend a lot of time on that, but a really common misconception, or you hear these people talk, oh my God, now you want to sell because the property market's up here. Well, yes and no. Yes, that makes sense. However, unless you are selling your property to travel the world, or you're selling your property to then rent somewhere else, or anything like that, which has its reasoning, and timing comes into that. If you're thinking about selling the property to then go buy another property, the market doesn't really matter. The only real thing that matters is your lendability at the time, your job situation. Why, Jamie? Why doesn't that matter? Well, because if the market has tanked 20% and you're going to be selling your property, now let's assume you still have equity and a deposit in this scenario, then everywhere else has tanked. If everything has dropped 20%, then you're on an even playing field. In the same way that if the market has boomed and everything's gone up 30% and you have your mate going, you should sell now, you'll never get a price better than this. They may be right, well, doubtful over the long term, but they may be right in the next year or two because it might retract at that point. But does it matter? No, because everywhere else is 30% up in the first place. So I really don't think timing matters in that scenario. But is it the same for buy-to-let property? So with buy-to-let property, I'd say it's fairly different. So why is my exit death? And it really comes down to one economic factor, which is capital growth. Capital growth is actually where a majority of wealth is made in long-term property investment. Now people go, invest for cash flow, forget capital growth. Well, that's just stupid, okay? Because you don't get to decide what capital growth is. It's inevitable over time. However, you can be smart about where you're purchasing to make sure the chances of that capital growth coming in are maximized and accentuated in the best way. However, I do get that you want to purchase for cash flow and that it is an actual income producing asset that will go up in value over time. Now what I'll do is Alex will put up some sort of animation here that we did previously where if you look back to the 1950s and the value of property, 1,700 whatever it is, all the way up to now where it's over £250,000, that is the impact of compounding and growth. Now some people go, oh yeah, but most of that's eroded by inflation. It's like, well yeah, but I'd still rather have a £250,000 property today rather than the £2,000, which would be next to fuck all today if I just had it sat in the bank. And the same thing will happen now. 50 years from now, you go, the average house price is £1 million, yeah, but most of that's eroded by inflation. It's like, yeah, but it's still £1 million, which is much better than the £250,000 that I put in originally. Obviously, that's if you pay in cash. So the reason why my exit is death is because of that compounding over time. Now, whether you should sell or not is really going to be down to your situation and your ability to make money. So what do I mean by the ability to make money? Well, what I mean is how much money can you make and generate in a fairly quick basis? Now, I'm not saying this to be smug or to impress you, but just as an example here is I can probably make £100,000 in 3 to 4 weeks with what I do. So I'm able to increase my net wealth, but probably about 25, 30 grand a week right now. And that will only increase. So let's say my average purchase price is 120,000. By the time I buy it, stamp, all of that, I'm in for 40 grand. Right. So if I find an amazing deal right now, I get a message through to my phone that goes, Jamie, we've got one to move forward with. I don't really need any money coming in from any other place or a refinance or a sale in order to facilitate that, because in about 7, 8, 9 days, let's call it 10 days, I'm going to have the 40 grand to buy it. Okay. Now, again, I hope that doesn't come across as smug, but what I mean is because I've been doing this now for almost 10 years, my ability to make money within property is a lot higher than most people. Okay, because of my time in the market. But let's assume your ability to make money is a lot lower. Let's say you're able to add in a couple of grand a month. Now, it's important at this point to understand that your net worth is your net worth. So please don't be imprisoned by your own bank account, okay? Your bank account is not a representation of how much money is out there. There are trillions of pounds exchanged every day in the market around the world. You just need a small slice of that to become a millionaire within a few years, right? I'm not saying you'll be a millionaire in a few years, but if your ability to make money is a lot lower than mine, then you might want to consider exiting some assets in order to utilize other things. This is the same with stocks, by the way. So I've got my stock portfolio and I've got some shares in different companies. Now, when I think a certain stock is not overpriced, but at a really good price, high price, and I own stock, but I feel, let's say Tesla, and I like Tesla as an investment, and I've got Games Workshop. Let's say Games Workshop is really high right now, but I own a load of stock, and Tesla has dropped because good old Elon's done some stupid shit like he will do at any one point, drops the Tesla stock, then I might sell off those shares to buy Tesla stock if my ability to make money wasn't there. The next thing is, why do you need the money? This is one thing that really gets on my tits a little. People talk about refinance, leverage to the hill, sell your portfolio when it's here, maximize the money. It's like, but if you don't have a use for that money, okay, then you're eroding capital. And what I mean by that is if my money's working for me in property at, let's say, 8%, which is a great return on your capital. So unless I've got something for that money to go into, and bear in mind, if I've got an asset that's paying 8%, bear in mind I've got my exit fee, so there's going to be solicitor charges, maybe early redemption fees, whatever else it is. So really, with this new asset, I'd need to be making maybe 11, 12% to make it worthwhile. Because am I really going to do that for an extra percentile? Probably not. The point is, always have your next investment lined up. It's kind of like, imagine you don't like your job, okay? Now, luckily, Alex loves his job and he's never going to leave me in his life. Right, Alex? But say Alex didn't like his job. Now, this would be the smart move. If Alex didn't like the job, but he's relying on the income to facilitate his life, like 99% of the country, right? It would be pretty stupid for Alex just to quit his job and then go, what now? Okay, you probably wouldn't do that if you've got liabilities. What you do is focus on finding a job in your spare time, put your notice in, work your notice, and work in the new job. Okay, in the same way with investments, okay, money is a prisoner, and I'm not a prison guard. I want to let go of it, free it out, okay? I am really weird. I have buffer systems. If you watch my POTS video, you'll understand how much money I keep in accounts and things like that. I hate it. I hate it. I do it for protection, not because I want to do it, okay? I'm one of these weird people. You might look at 100 grand extra in your account and be like, woo, yeah. I'm the sort of person that's like, I get edgy. I'm weird. I don't want the money in there. I want it out working for me, okay? I want to employ these pounds, sterlings, and get them working and generating this for me, okay? So unless I've got something to put the money into, I'm not going to do it in the first place. Now let's assume you've got something, some use for the money that's going to come from selling your property. Now, considering we're talking about buy-to-lets, I'm going to assume it's either some sort of investment, right? But do you need to sell it in order to to activate or get access to that capital? And the answer is no. There's a couple of things that you can do against this. So first of all, you can refinance the property. Let's say you bought the property and you're all in 100 grand, and for whatever reason it's worth 150 grand right now. Now, you could sell the property. The thing with that is, are you going to get that much money? Well, no, because you're not going to get 150 grand. You're going to get your costs off, your estate agency fees if you're going to use an estate agent, which most of you will. You're going to have your early redemption charges, if there are any. You're going to have any final charges, and of course the mortgage to pay back, the debt. Then you're left with the equity plus the profit. If you don't need access to all of it and you're not in a rush, why not refinance it? Okay, now what a refinance is, for those that don't know, or a remortgage, is where you are getting a new valuation on the property. They come out and go, hey, it's worth 150 grand. They won't actually say it like that, by the way. So they go out and they say, hey, it's worth 150,000 now. We're going to refinance or remortgage on that, and we're going to give you 75% of that. So 75% of 150,000 is 112,500. That 112,500 is going to go in the bank. Let's say you got 70 grand worth of debt. 70 grand goes over there. Then you're left with the 42,500 in your pocket. Thank you very much. I've still got the asset that is income producing and paying me. I'm going to benefit from the capital growth, and I've got the lump of cheese in my bank account ready to go out again. Okay, that's what we're looking for. Now, what do you need to look out for if you go down that route? Well, what if the market corrects? What if you've refinanced at that higher thing? So I'm not giving you financial advice here, but what I like doing on refinances, not a very popular opinion, but I like refinancing on a 5-year fixed term. The reason why I like 5-year fixed terms, most people do 2 years, by the way. The thing is, 2 years actually don't work out that much better. When you factor in 2 years later, you're probably going to need to then pay for a new product and all of that. You're going to end up paying about 0.4% more per annum for a 5-year. Okay, but the risk mitigation's there. The reason I really like it isn't just the cost mitigation, it's the risk mitigation. So if the property market does correct at any point, and you don't know when it's going to happen, but it will happen eventually, okay? So if it corrects in the next couple of years, then when I come to refinancing it, it will get refinanced at a lower value if the market has corrected, and then I will have to put in money in order to keep the property. Or I have to keep it at what it is and pay the variable rate, which may or not be higher or lower. Hopefully that makes sense. Now you might not care on one property, you have to put in 5 grand. Well, what if you've got 100 properties? Okay, 500,000 suddenly like that, that gets a bit scary. I think by refinancing over a 5-year fixed period there aren't many. Okay, there are some, but there aren't many since the Doomsday Book in 1088 or whatever it was. There aren't many 5-year periods in property where the value of the property hasn't been the same or higher than it was 5 years ago. That's enough information for me to feel fairly safe in the growth of my portfolio. So as promised, how do you time the market? How do you actually understand when to sell or refinance if you want to do it? Well, first of all, there's quite a lot of telltale signs in the market. First of all, a lot of motivated buyers. Okay, you've got motivated buyers, and by the way, at the time of filming this, there's a lot of motivated buyers. There's people going into auction paying way over the odds. I am noticing it softening a little bit, but loads of motivated buyers. You've got loads of people just throwing money at projects. Now, should you buy in this situation? Absolutely. I still buy property regularly. In fact, we just agreed another one yesterday. Our investors are buying property all the time, but that doesn't matter because our criteria doesn't change. Okay, it just gets harder to find the opportunity, so I'm definitely buying less, but I'm still buying as long as it hits my minimum criteria. So number one is motivated buyers, which is never a good thing. Well, it's good for inflating the prices, but not long term. The other thing, I know this sounds weird, taxi drivers. Taxi drivers are a great indicator. When your taxi driver is telling you to get into something, that's usually a time. Think crypto, okay? When the last time that crypto crashed, just before, you'd have your taxi driver telling you, I've just put 10 grand in, you should be doing this, it's done that. We've got Sandra down Co-op down the road telling us about Dogecoin. Then it dropped 40%. Now, I'm not saying they are the antonym of success or anything like that, but when you've got people that know fuck all about investing telling you to jump on the bandwagon, that's when I get a little bit more cautious. I still buy, by the way, just a bit more cautious going in. The next thing is market forces. So a lot of people just think markets go up and down through supply and demand, but actually they're artificially increased or suppressed. So always look at the market forces around you. So for example, right now, post-COVID, we've got the 5% deposits, we've got stamp duty getting delayed, we've got furlough getting extended, we've got cash injections, everything inflating the property market right now. But ultimately, how do you time the market? You can't. Okay, I'm sorry to burst the bubble, but nobody is sat there with this crystal ball, and you have these arseholes that got it right once or twice in the last 30 years, and they go, a lot of people said you couldn't predict the last recession. I did, because I was a technical trader or whatever. It's like, no, you didn't, you knob. You've got all these people that are insane predictions, like Ray Dalio as an investor, for example. He's had some amazing predictions, but everyone remembers the 5 predictions that he's had over the span of 50 years. What about the thousands of predictions that actually weren't correct? In the same way, if you look at Bitcoin, how many Bitcoin billionaires are there? Oh my God. Yeah, what about all of the people that jumped in after and lost all their fucking money? Okay, you have to bear in mind that everyone focuses on the very few winners in life, not understanding that for every winner, there's hundreds of losers. So I'm sorry to be the one that says this, but should you sell your buy-to-let property? No, not unless there is a strict reason of selling that property at any given time. Like you are in desperate need of the funds, you've got a great project coming on that you need the money for. But otherwise, no, you shouldn't sell your property. And the whole problem with that is nobody can time the market, no matter what anyone tells you. Like how many people, including myself, thought the market would correct, including me, by the way, last year. There's corrections. Oh, then the government comes out with this stimulus. Okay, well, that delays it, right? Do I think there's going to be a correction? Yeah. If I keep saying there's going to be a correction, will I be right? Yeah, at some point. If I keep saying there's a massive boom, you'll be right at some point. The problem is, when's it going to happen? I don't know. Time in the market will always be timing the market. But there is a way you can increase your experience and reduce your risk and increase your opportunity to make significant money in property. And that is by liking this video, subscribing to the channel and smashing the notification bell. Hope you enjoyed this video, and I'll see you in the next one.